Welcome back to my channel. Today I am diving into a topic that has big influence on the world of real estate, and that is interest rates here in Canada. Don't worry if you're new to this. That's why you're watching this video. I'm here to break it down for you in a simple and understandable way. Hopefully, let's get into it. First things first, what are interest rates? Think of them as the cost of borrowing money. When you want to buy a house or any big thing that you're going to need a loan from the bank for, you are going to be charged an interest rate. And this is the fee that the bank is charging you to use their money. And it's normally shown in a percentage point. In Canada, the big boss in charge of interest rates is the Bank of Canada. They set something called the policy interest rate or the overnight rate. This rate affects how much banks can charge each other for borrowing money overnight. When this rate goes up, banks will charge you more to borrow money. What's known as the prime rate is the amount that banks and financial institutions charge us, the consumers, for things like mortgage loans and lines of credit. Typically, as the overnight rate changes, so does the prime rate. Now, here's where it gets interesting for real estate. Let's say you want to buy your dream home and apply for a mortgage from the bank. If the interest rates are low, it's like borrowing money at a great deal. Your monthly mortgage payments are going to be lower, and that will make the home more affordable for you. But if the interest rates are high or on the rise, like they are right now, the cost of borrowing becomes greater and home ownership becomes more expensive. Low interest rates can make it more appealing for people to buy houses. When more Canadians want to buy, the demand for housing goes up. This can lead to higher house prices because sellers know there is lots of interest in their property. So the real estate market can get pretty active when interest rates are low, and we have seen that. This has been the case since 2020, when interest rates were at all-time lows. But in an effort to slow down this crazy rise in home prices, the Bank of Canada has been sharply raising interest rates for the past 2 years. Now, the Bank of Canada has a challenge. They want to keep things balanced. If they keep the interest rates super low for a long time, Canadians will borrow too much money, and this is going to cause problems for us down the road. On the other hand, if they raise the rates too sharply and too quickly, it could slow down the economy or put us into a recession. This is a major concern for most Canadians right now. Interest rates also affect investments and savings. When interest rates are low, it's not great for your savings account because it's not earning any interest in there. Because of this, we see some investors that might look towards real estate as a better option compared to saving money or other investments. This can put additional strain on the housing market due to that additional investor demand. So there you have it. That's the scoop on interest rates and how they affect the Canadian real estate scene. Remember that interest rates affect the cost of borrowing money, can impact your mortgage, home prices, and even your savings accounts. Let me know where you think interest rates are going to go in 2024. Leave a comment below. I'd like to know what you have to think. And if you found this helpful, share it with someone who might need this information. Give it a thumbs up and subscribe if you want to see more videos like this one.